While the housing market seems like the least of our financial worries right now as stock markets are melting down around the globe, we track the housing market here at HousingWire, so it opens a question. How quickly could we see the impact in housing, and in which data would we see it first? We have two competing forces that will impact homebuyer demand. Mortgage rates, of course. If rates fall, that obviously helps demand. But if the economy shrinks, unemployment spikes, and people are worried about their wealth or income, those are negative forces. So rates versus recession. What if rates fall because the economy tanks? Which force wins then? So this is tricky because we haven't had to worry about the economy for 15 years. In housing, it has been an interest rate game for a very long time. Rates go up, demand weakens, inventory builds. Rates go down, demand increases, inventory falls, prices rise. In the past 3 years, we've had rising and elevated interest rates, and inventory is way up. But in that time, unemployment has been very low. So the US economy has been growing basically better than anywhere in the world. So housing has been primarily an interest rate game. But if we face a situation where the economy shrinks, will that decrease household formation and housing demand? That means if mortgage rates move a little bit lower, we could still see decreased demand for housing and for rentals too, by the way. So what's frustrating is that home sales had been ticking up in recent weeks. The weekly pending home sales are starting to come in a couple percent above the year ago levels. So will that metric be the first to turn south? Will we see price reductions tick higher, or will we see it in the new listings volume? Or what if we don't see the impact at all? So I pointed out lately that the American homeowner is in a very strong financial shape. And their strongest financial asset is the ultra cheap, locked in 30-year fixed mortgage. Stock market wealth can evaporate by trillions of dollars in a matter of days. We can lose our jobs, but even if home prices outright crash, Americans have the ultra low mortgage rate locked in forever and have the lowest loan to value ratio in essentially forever at only 47%. So we are under leveraged on our homes. So even if home prices crash 20% across the board, like bigger than 2008, American homeowners will still have a ton of equity, and home prices could indeed fall. There's no signal of a crash anywhere in the data, but they could fall. And there are 8 states now with lower home prices than a year ago. But you can't take away that great mortgage. And that's important because we've never entered into a recession cycle with homeowners in such a strong position. Now, some of those homeowners are over leveraged on their cars and credit cards and will lose their jobs. And some of those folks will be forced to sell their homes. But think about it this way. If I have a 3% mortgage and I lose my job, I can't sell the house and rent somewhere else cheaper because my mortgage is the cheapest I'm ever going to get. So I'm going to fight like hell to hold on to that house. So the point is that we suddenly have new forces, not just mortgage rates, driving real estate demand and supply. So it is more important than ever to track the weekly moves in the data. We'll take a quick dive into these market dynamics today. Of course, in 2 weeks, April 24th, Thursday, will be our webinar where we get to take a full hour to explore all the data, including the latest economic impacts that we'll see in the next couple of weeks to the local markets, which are at 2 far ends of the spectrum, the Northeast versus the Sun Belt. Lots of powerful data to cover. If you need to communicate about the housing market, you should join us on these webinars. There's a link in the description below to join. These are limited to 1,000 attendees each month, so click that link to reserve your spot. Okay, let's take a look at the data and we'll see the specifics. I'm Mike Simonsen. I'm the founder of Altos Research here at HousingWire. We track the entire US housing market every week so that you get the insights far before the traditional channels. If you need to communicate about this housing market, Go to altosresearch.com to get your data for your local market today. Okay, let's start today with pending home sales, the weekly pending home sales. Even as economic craziness looms large on the horizon, as of the beginning of April, home sales have been ticking up finally. So people who made offers this week on homes obviously aren't going to generally yet impacted by like new policy insanity. So home buyers are marching forward. In fact, my gut says that stock market turmoil doesn't translate into too much change in home buyer demand in the immediate term. So, in fact, rapidly lower mortgage rates could help move some buyers off the fence in the next couple of weeks. So, for now, for the next few weeks, expect slight momentum in home buyer activity to continue. So, there were 72,000 newly pending home sales this week for single family homes. There were another 15,000 condo sales newly pending, so 87,000 total. Uh, was the most weekly pending sales since the end of April a year ago. So, because mortgage rates were rising quickly back then, home sales slowed in May, June, July. So, this pattern has been on a trajectory to finally see some sales growth over 2024 with slightly lower rates. So I expect in the next couple of weeks, unless things get crazier in the financial markets, to continue that trend. Last year at this time was the Easter holiday, which was very early in the year. So the comparison with sales last year is a big jump. There were 11% more home sales now than the same week a year ago in the Easter week. In the chart here, you can see this year's purple line is starting to march above the blue line from 2024. This year's line will have the Easter holiday dip later in the month. There are 368,000 single-family homes in contract pending. After a few weeks of increasing weekly pending sales, there are now more homes in contract than last year, just 1% more than a year ago, but it's inching higher. So homes in contract now will close, say, the transaction mostly in April and a little in May. So the takeaway from home sales is to expect that we will see slight gains through April unless real catastrophe is unleashed. And we'll be able to see how here in this data how quickly demand turns. Onto the supply side, the trend for 2025 is that we have more sellers each week, finally growing to the old normal levels. So there are 72,000 new listings this week for single family homes. That's 5.8% more new listings than a week ago. It's 31% more sellers than last year at this time, but that was the Easter holiday, so it's not a direct comparison, but more sellers. Back in 2019, there were 85,000 new listings in the first week of April, so 72,000 now isn't a lot, but it's the most for this week in the 6 years since then. So new listings are growing. They're not overwhelming. So in this chart, each line is a year with a weekly new listings counts. The gray lines at the top of the chart are the years before the pandemic, 2017, 18, 19. In those times, it was totally normal for 80 to 100,000 sellers of single-family homes to list for sale each week. The purple line here shows 2025 is finally getting closer to those old normal levels. The blue line is last year, and every week we have more sellers than a year ago. Seller growth is inching higher across the country, even in places like Connecticut, which still has ultra low inventory. Some of the new listings growth is from 3 years of more expensive mortgages. The more folks with a 6 handle on their mortgage, the less likely they are to hoard real estate. So those get relisted faster. Some of the new listings growth, I suspect, is from early sensitivity to a changing economy. Sellers who want to get out before it gets worse. So, like I said, we haven't had this dynamic in a very long time, with the exception of like a few weeks at the start of the pandemic. So, watch the new listings rate to see if homeowners buckle down and keep their great mortgages, or if economic forces dominate and force people to unload. So far, the rising seller volume I characterize as generally healthy. More sellers is good. There are now 691,000 unsold single-family homes on the market. That's an increase of 2.3% or 16,000 homes this week. That's a solid increase, though. It's not crazy, just like the new listings. Like the pattern is supply is growing, but it's not exploding. Now, unsold inventory is 34.75, so almost 35% greater than a year ago. The gap compared to last year is expanding. I had been expecting it to compress a bit, but that is not happening. So it's looking more and more likely that 2025 is the last of the inventory shortage, at least at a national average. Keep in mind that most of the inventory gains are across the Sun Belt, and inventory is still very tight in the Northeast. But as we look at the long-term trend of unsold inventory in the US, the takeaway is that plenty of supply gives very little, it implies very little home price appreciation pressure. As we move out of the shortage phase, we can already see price pressures finally materializing. And indeed, when we look at the prices, we can see how there is little or no home price appreciation over 2024. In fact, on a national level, home prices could turn negative this year. The median price for this week's newly pending home sales was $397,500. That's just 0.25% higher than last year at this time. Now, this is a national average. There are 8 states with lower prices than last year at this time. So Texas and Florida, Arizona, Georgia, South Carolina, across the Sun Belt. But we're also tracking Iowa, South Dakota, and Washington, which have slightly lower home prices than last year. And I expect Colorado, Louisiana, and maybe Tennessee would be the next states to go negative. So 2 takeaways from home price data. First is that there's nothing in the data that says home price crash. When I say negative, it's like 1 or 2% lower than a year ago. These are slight moves. Secondly, if mortgage rates were to react to economic turmoil and drop quickly, then I'd actually expect a bit of a bounce, a price bounce like we saw in September of last year, which you can see here in the blue line at the right end of the chart. Price reductions are often a very fast indicator of demand shifts. So when mortgage rates spike, price cuts spike almost immediately. That's because when a house is on the market expecting offers that don't come in, one immediate tactic is to do a price cut to stimulate demand. You can see those moments when mortgage rates spike up, they show up in price reductions in this chart. For example, in the green line, which I've highlighted from 2022, starting in March, mortgage rates were climbing and then spiking again in September of that year. Price cuts happen pretty much immediately as the demand shifts. So this year, as of the beginning of April, home buyer demand has been weak for a while, so price reductions are high. 35.1% of the homes on the market have taken price cuts. That's more than any April in the last decade. Price cuts barely budged higher this week, though, which implies some reasonable support from demand. This year's purple line remains elevated, and that tells us how little forward pressure on home prices there is already. Now, as I've mentioned, my gut says that like stock market turmoil, tariff turmoil doesn't translate into too much change in home buyer demand immediately. In fact, rapidly lower mortgage rates could move some buyers off the fence in the next couple of weeks. My gut says that in the next few weeks, the recent slight momentum in buyer activity continues. But if fear does begin to pervade the housing market, we'll see it in this data very quickly. If that house is on the market now expecting an offer and it doesn't come this weekend, they cut the price on Monday. So we see the demand changes very quickly in this data. Okay, that's all the data we have time for today. If you need to communicate about this housing market with potential buyers and sellers, There's a lot of fear in the market right now, and the data is the antidote to the fear. So you can join us at Altos. You can get a free account with your local data. Go to altosresearch.com, run a free report. Let's get started today.